So I was just shooting some videos for Cassava Sciences on our other channel, Traders Helping Traders, and I was talking about being careful playing options because the implied volatility is ridiculous right now. And so I figured, I actually don't think I have implied volatility videos. So that's what we're going to do today. Now I do have the whiteboard/blackboard up. I don't know if you guys like me writing on this thing or these types of videos, but for me, my whiteboard in my office has made me so much money that I never even thought I could, just because I am such a visual person. I need to actually like write everything on a board and then be able to see it. So if this does help you guys, please let me know. If it doesn't, let me know as well, because this channel is for you guys, and whichever way you guys learn as a general public is the best way for me to teach. Now, there are a lot of reasons as an investor that you need to understand implied volatility when it comes to options. If you're somebody who plays leap options, sells cash secured puts, sells covered calls, dual wheel strategy, there's reasons that you need to use implied volatility to your advantage and understand what bad IV does. Now, if you're somebody who doesn't understand what a leap is or what selling puts is, you can watch the videos we have on the channel. You can just type in Peter DeCarlo selling puts or whatever it is. You'll be able to find it. That's not what this video is for. This is explaining implied volatility and why it goes up. Also, the effect that it has on the premium of a stock within IV Crush. So, implied volatility, for those of you who do not know, is usually higher when we have a lot of volatility, obviously, right? So you'll see here when you're looking at an option, it'll say something like IV, and that's going to be a percentage. So on something like Apple, where there's very low volatility, you're normally going to see something like a 35%. Now, when implied volatility goes up, it's because volatility in the market has gone up. If you're looking at a stock like Apple, you will see something like an implied volatility of 35%. That's because the company is very, very sound. There is not a lot of volatility or uncertainty around the company or the company going bankrupt. So you're going to see implied volatility go lower. Now, if earnings is coming up, then you might see implied volatility go up to like 45%, because earnings itself is going to raise volatility momentarily. It's going to raise volatility for potentially the next week or so. Now, with a company like Cassava Sciences, the company is very, 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 very volatile. Number one, because the stock price constantly moves. Number two, because there's been some scrutiny that they potentially lied about a study that they were doing about their Alzheimer drug. Then it came out from the Journal of Neuroscience yesterday that didn't happen. So there's a ton of volatility, and the stock is swinging from like $150 down to $45, back up to $80. So there's going to be a lot of volatility. And when there's a lot of volatility, this volatility number rises. So right now we are seeing implied volatility of about 175%, which is crazy. Some of them are even 300%. So highs over here is like 300%. Now, why is this important? Well, because you're going to have, with implied volatility, you're going to have let me go to this. Let me get rid of this really quick. You're going to have a contract price, or what we call premiums. So if you guys know what a premium is, I don't know if you spelled that. So with a premium, that is going to be basically the price of the contract. And then you have to actually times that by 100. So let's say a premium right now is on Apple. Say a premium is $200. Which would be $2 times 100, yada, yada, yada. So if we look at Cassava here, let's say a premium for this is like $55. And like I said, this would be 55 cents times $100. Now, let's say that with Cassava Sciences, our premium is $55. And it comes out that their drug gets FDA approved, which is possible. But let's say that the stock now goes parabolic, straight up. And what was worth $55 for your premium, or the premium back then, is now worth something around $1,500, because the stock has gone up significantly, which raises the price of your premium. But on top of that, now your implied volatility has gone from 175% up to 300%, which we talked about earlier. Now, for the person who bought this back when it was worth $55 a contract, bravo to you. Number one, did you make a ton of money? But this implied volatility is not going to really crush you, because you're probably out of that position. Now, for the poor sap who comes in at all-time highs believing that they're going to buy it and that the stock is going to continue to push up, this could have serious, serious consequences for that person, which I don't want you guys to be that person in general, but let's just say that does happen. So as implied volatility goes up, it is going to make the price of the contract go up as well. There are a lot of different things that move a contract's price. It's going to be the amount of volume, the amount of volatility, the delta on the underlying stock, how the underlying stock performs. It's not just one thing that moves premiums here. So that is something important to understand. Now, when IV crush occurs is when we have a $1,500, or whatever the price of this contract is. We have huge implied volatility. And then we get that certainty back. So now we find out that actually the stock is going to be FDA approved, but maybe the FDA approval is not going to happen for another year. And this volatility, this IV number, let's say the stock drops 5% and now the contract would be worth, with the same amount of IV, $1,200. Well, the IV drops from 300 to 150% because there's less volatility, and this shaves off, $700 and $900 worth, and now your contract's worth $750. And all of this was because of your implied volatility. What you have to understand, implied volatility also works off of theta. So when your implied volatility is high, your theta is going to go up as well. All of these things are important. And that's why I have a lot of different things that I tell my students in our private academy that you need to watch for if you are going to be a options trader. And even if you're going to grab some leap options, it's still very, very important for you to understand this. So let's go over some of the main things that I would say. As a trader or investor, I want my IV to be under at all times 100%. The lower, the better. I want it under 100%. If it is over 100%, that is not good. We do not want that. That means that we could have IV crush. There's too much volatility in the market. We don't want that. 100% is the actual max that I would ever do. Normally it's like 75%. The other thing is that I don't want to play anything that expires within 2 weeks. I always say go 4 weeks further than you think you need. This is very important because the further out in time that you go, right, your further time horizon, the lower your IV is going to be and the lower your theta is going to be, which is very important. 4 weeks out further than you think. And then if you're going to go with a leap, which we're not going to talk about this right now, you want the highest delta possible. Highest delta. You want the highest delta possible because what delta means is that, let's say we have a delta of 0.65 and a delta of 0.90. If our delta, I'll write it here so you guys know delta. If our delta is 0.65 right here, that means for every $1 that the underlying stock moves, you're going to make $65. If our delta right here is $90 or 0.90, that means that for every $1 that the stock moves, we're going to make $90. So you want high delta, you want low implied volatility, you want low theta decay. All of those are important. Now, if you want me to do a video on actual like leaps and how you can use leaps to make the most amount of money and some things to watch for, like we said, your delta, your theta, your IV, go ahead and let me know in the comments. I can definitely do a video on that. But for now, I just wanted to quickly hop on, show you guys implied volatility. I hope that helped. For those of you who already know, it's all good. See you guys in another video. But for those of you who don't know, comment down below and we can continue to talk about this if it helps, guys. Thanks for all the support. Go and check out the Discord. It is completely free. Link is in the description. I'll see you next time. Peace.